Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is John Mayer, Chief Investment Officer at Global X. So Global X, we know, is a leader in thematic investing. They offer more than 96 ETF strategies in the US with about 39 billion in assets under management. Today we are talking about the Inflation Reduction Act of 2022, which was signed into law by President Biden last month, and ETFs that could get a boost from this act. John, welcome back. Great to have you on the show.
Thanks for having me, Neena. Happy to be here.
So I wanted to start with the recent market action because it's been such a roller coaster, and we know that stocks were under pressure, particularly since Fed Chair Powell indicated that the central bank would continue raising interest rates and hold them at a higher level until inflation is under control. And that he said at the Jackson Hole Symposium. They are rebounding today. And for the purpose of reference, we are talking on Wednesday, September 7th. So tell us about your thoughts on the recent market action, and also what lies ahead for stocks in your view.
Sure. It always feels good when the market is up, and that's just one day, and you have to look at it in a broader context, of course. And the market, from our perspective, is really being driven by the Fed. And I think the Fed faces a challenging balancing act between the elevated inflation that we're experiencing right now, as well as slowing economic growth. So the Fed is raising interest rates while the U.S. economy remains in a relatively strong position, especially relative to most developed economies around the globe or emerging markets as well. If you look at some of the unique dynamics in the U.S., we have unemployment, which is historically low. And also the consumer has a buffer, some buffer from the pandemic savings. And what we're concerned about going forward is consumption, and that consumption certainly could slow in the not too distant future, and certainly assisted by Fed action. So what we have is right now is elevated inflation. We have slowing global economic growth expectations. We also have reduced central bank liquidity. And this overall creates a typical late cycle environment with some extra complications. Some of those include the war in Ukraine and what that is doing to the global energy markets. And certainly Europe is in the crosshairs of that issue. And this all places a greater focus on the aspiration for cleaner energy and a future that is less reliant on fossil fuels and less reliant on a particular country or region for energy needs, because everything is connected. And whether it's a U.S. problem or a Europe problem, global energy prices are essentially one. So that impacts things in the U.S. And what we believe is that market volatility is going to remain elevated through this interest rate hiking cycle, and the Fed is not going to take its foot off the gas until there's a clear sign that they have inflation under control, and it brings it back to the Fed's goals. Also, other unique factors that are going on right now is that the U.S. has, we have a very strong dollar, and that is a function of that the U.S. is doing better than the rest of the world. You look at inflation in the U.K. Inflation is a lot higher than the U.S., and that's largely focused because of the energy issues going on over in Europe. So we do believe that we're going to experiencing greater volatility for the near future, but there are pockets of areas that we think make a lot of sense, particularly in light of the Inflation Reduction Act that was passed, as you mentioned, last month by Biden, and that has implications for a lot of different areas that Global X has ETFs in.
So, as you mentioned, inflation is likely to stay at elevated levels, global growth will continue to slow, and central banks around the world are reducing their monetary accommodation. So, keeping that in mind, how should investors position their portfolios for the rest of 2022? I mean, in addition to looking at potential beneficiaries of this Inflation Reduction Act, which we are going to talk about in a bit. Apart from that, how should investors stay invested for the rest of this year?
There's what we've been talking to our clients about, and particularly for the core exposure of a portfolio, we believe there should be an increased focus on defensive segments with strong cash flows. So some of those sectors include healthcare, staples, utilities. Discretionary consumption remains an area of concern. But in light of this inflationary environment, commodities certainly can benefit. And we do prefer commodities over some other asset classes. But there's somewhat of a muted outlook there. There's Chinese uncertainty also clouds the outlook for economic growth around commodities. But if you kind of shift towards where spending is going to occur in the Inflation Reduction Act, remember that we have about $370 billion from this bill that's going to be spent over 10 years that's largely targeted towards addressing climate change. So that would positively impact renewable energy, clean tech companies. And we did see a short-term boost in performance after this bill was passed. But we also believe that this bill will help spur investors' interest towards solar and wind and electric vehicles, which will be the key beneficiaries of this bill. And clean tech companies certainly will also be beneficiary. Also, by one estimate, the Inflation Reduction Act could drive about $3.5 trillion in cumulative investment over the next 10 years. So there's a lot of tangential investing that will go alongside with the spending that's occurring or the tax credits received as a result of this bill. So again, just to kind of reiterate, we are more defensive in our core exposure and focusing on companies with strong cash flows, the ability to pass on some of these higher inflationary costs to the consumer, as well as dividends and companies that pay dividends or potentially increase their dividends. That would be a core exposure. And then you would augment that with some exposure from this commodities as well as beneficiaries of the Inflation Reduction Act, which would be the renewable energy companies, clean tech companies, as well as lithium miners and battery producers.
So, as you mentioned, this Inflation Reduction Act provides $370 billion to combat climate change. And in fact, this would be the biggest climate spending package in U.S. history. And so tell us a little bit more about this act. What exactly is in it?
The Inflation Reduction Act, which you mentioned, spends about $370 billion over 10 years. And also, as I mentioned, it will spur an estimated investments of about $3.5 trillion in cumulative investment over 10 years. The key beneficiaries are renewable energy developers and producers, manufacturers of wind, solar, battery, and energy storage companies and component parts for these technologies, as well as hydrogen technology, the electric vehicle value chains, energy efficiency and green building companies are also beneficiaries, and also miners of critical minerals such as lithium. So all of these types of companies and industries will be beneficiaries of the Inflation Reduction Act.
So let's talk a little bit about your Lithium ETF. It is the Global X Lithium and Battery Tech ETF, ticker symbol LIT. And in fact, this is your most popular thematic ETF with over 4.4 billion in assets. So this is very popular because this is the only ETF which provides pure play exposure to lithium companies. And lithium, I think, is a very, very interesting metal. it is one of the hottest commodities in the world because this has about double the energy density of the next closest alternative, and mainly because of its high density energy storage. It is used in rechargeable batteries for electric cars, smartphones, laptops, and many other electronic devices. Now, it seems that there is quite abundant supply of lithium in Earth's crust, but its extraction is costly and time consuming. So it seems there is lithium may not be enough to meet the surging demand. And then there are many climate-related concerns related to lithium mining. There are pricing efficiency because there's no futures market, no developed futures market for lithium. So tell us about little bit about lithium and your lithium ETF.
Thanks, and those are all really good points, Nina. And just to take it about lithium and the demand for lithium, demand is great, supply is short, and at least the immediate supply is short. So lithium takes years to mine, and it takes a long time to bring to market in a usable form. There's some really cool YouTube videos on how lithium is mined and how at high altitudes in South America where there's brine pools of lithium, and it takes years for it to become usable in battery production. And on the heels of the Inflation Reduction Act, as well as if you're looking at every major car company has announced initiatives to make electric vehicles, and the need for lithium-ion batteries is just increasing at a very high rate. So that just means that, it's a simple supply and demand story. There's not enough supply, there's a lot of demand, and there's going to be a lot of increased demand as a result of initiatives by car companies, this act that was just passed, the tremendous amount of spending as a result, both from the act as well as tangential spending. So over the next 10 years, you're going to see a doubling or tripling of the need of lithium, which likely just will mean a higher price. Now, if you look at our lithium and battery technology ETF, the symbol is LIT, this ETF invests in companies that including mining companies, refinement, as well as battery production. And it also cuts across traditional sectors and geographic definitions. And lithium and battery technology that uses lithium is essential to the powering of electric vehicles. It's a great renewable energy source, lithium. It also powers other things besides electric vehicles. It plays into solar and wind as well. And as such, there's been a great demand for this ETF because it's a way to invest, a one-stop solution to invest in lithium miners and companies that make batteries for largely electric vehicles. And if you look at battery storage, battery energy storage systems, an acronym for that is BESS, BESS. Batteries typically have a storage of duration of about 4 to 6 hours. And the commodity that's used in most of these batteries is lithium ion systems. And until we develop something else, and there's certainly some research and development that's going on, this is the primary source of energy that's going to power the electric revolution. So we believe that lithium is going to dominate the story for quite some time, and it's certainly the commodity of choice for energy storage.
Yeah, I agree with you. Lithium is a very interesting commodity, and this ETF is definitely worth a look because of the surging demand for lithium, which will continue in the coming years. So Global X also offers many other ETFs that provide exposure to clean technology and alternative energy companies. Among those are CTEC, the Global X Clean Tech ETF, RNRG, the Global X Renewable Energy Producers ETF, and RAISE, which focuses on solar companies. It's the Global X Solar ETF. Talk to us a little bit about these ETFs and how they will benefit from the Inflation Reduction Act.
So the way I would group these three ETFs is CTEC and RAISE really focuses on alternate sources of energy, clean technology, and RAISE is more of a utility. So if you look at CTEC, it's designed to track the performance of companies that develop technology or equipment for the production of energy from renewable sources. You have the efficient utilization of energy and of the overall reduction of the negative impacts on the environment. So that would be clean technology, which is in the name. And if you look at companies that are eligible for inclusion in our CTEC ETF, at least 50% of their revenues have to be derived from what is considered pure play clean technology companies. Renewable energy production, residential and commercial energy efficiency, smart grid implementation, those are all potential inclusions within CTEC. Now, RAISE, this tracks an index that's designed to track the performance of companies that have exposure to, obviously, solar technology. We spent a lot of time looking for the right ticker, and RAISE, RAYS, we feel is a good representation for solar technology. And again, for inclusion in this index, your companies are eligible if they at least 50% of the revenues are derived from solar activities. You think about solar energy materials, different components that are needed for the production of energy as a result of solar. And then you look at RNRG, which is a little bit different. This is largely utility exposure. Utilities have done rather well this year as they're a safe haven from and they're more domestically focused. And this index that RNRG tracks is designed to produce, the companies produce energy from renewable sources. So this provides a bit of a yield, more of a play on clean utilities versus the other two are clean technology as well as solar technology.
Yeah, RAISE is definitely a very interesting ticker, a great choice over there. So I also wanted to talk about your Uranium ETF, and the ticker symbol is URA. And I wanted to talk about this ETF because there's so much interest in nuclear energy lately, and that is because of this global energy crisis, which is resulting mainly from the war in Ukraine. And so governments around the world are trying to ensure energy security by reducing dependence on Russian fossil fuels. And at the same time, they also want to move towards their goal of achieving carbon neutrality. So uranium, which is used in nuclear power plants, it is one of the cleanest ways to produce electricity, but currently nuclear energy accounts for just 10% of global energy production. And this Inflation Reduction Act also includes about $30 billion in production credit to existing nuclear power plants over the next decade. So this act would also support nuclear energy and uranium. Talk to us about your Uranium ETF.
Thanks for that, Nina. And uranium is certainly an area that is sparked interest in the market, and it's obviously a key element that's needed for the production of nuclear power, which, as you pointed out, is a clean form of produces energy with almost no emissions, and there is some waste that is produced from the production of power from nuclear power plants, though it's in rather small amounts. But nuclear power is clean, it's efficient, and it's really important as a point of transition into cleaner technologies, into reducing our carbon footprint, and the impact of climate change. And this will be certainly helpful. Nuclear power can be produced at great scale. And the great part is just minimizes greenhouse gas emissions. And there is the price of uranium has certainly come down from its peak, but it's certainly off its low. And we believe that, considering that there's a meaningful amount of power plants that are going to be built, in China and elsewhere around the globe, that uranium is an element that is going to be in short supply. Thus, this Uranium ETF is uniquely positioned at the moment to capitalize on that need. And we are seeing a lot of interest in this ETF. And again, there's always some controversy around nuclear, and there certainly has been a couple of nuclear incidents around the globe, whether it be Chernobyl. But if you look at per person, it's really the negative impact is rather small, and the positive impact of producing nuclear power without producing greenhouse gas emissions is a rather positive. And it's really it's a key element in our transition to cleaner energy.
So as I mentioned earlier, Global X is a leader in thematic ETF investing. So I also wanted to talk to you about the role of thematic ETFs in a portfolio. Tell us how they should be used in a portfolio, because these are all excellent themes, the ones that we discussed today, and other ETFs that are offered, other thematic ETFs that are offered by Global X. They all have a lot of growth potential, but they are generally more volatile than broader indexes. So tell us how they should be used in a portfolio.
Sure. I manage our firm's model portfolios, and right now we have, in the US, we have 13 model portfolios. We have several thematic portfolios, as well as asset allocation models that, as a differentiating factor, we use thematics inside of those portfolios. Now, if you look at our asset allocation models, which are really good examples of a complete portfolio, and based on risk tolerance and time horizon, it depends on how much inclusion of a thematic exposure you want to include in a portfolio, because, as you mentioned, it likely will add volatility. Periods of time it's going to add alpha, other times it's going to detract. Obviously, this has been a more difficult year for growth momentum investing, and that's really where you find thematic investing. Now, we believe that when you're looking at thematics, you really should take a more of a 5 to 10 year time horizon, because themes develop over different times, and you don't necessarily know when you're going to capture that exact moment. During the pandemic, a lot of the different themes, whether it be cloud computing, financial technology, cybersecurity, they all did rather well. And right now we're seeing a bit of a pullback, but that doesn't take away for the structural shift that you're seeing, the trends that are changing how we're investing, how we interact with data and the protections of that data. So again, it's a longer term investment, and thus it really depends on your risk tolerance and time horizon. So if you think about a moderate portfolio, how much of this kind of growthier momentum exposure would you like to be exposed to? At the moment, we are suggesting about a 6% allocation in a moderate portfolio, and that allocation goes up based off risk profile. So we believe it's important to have this type of exposure in a portfolio because it has very little overlap with your other portions of your portfolio. Your more traditional 60-40 allocation of stock, bonds, and cash, you're likely going to have a minimal amount of overlap of the inclusion of kind of a thematic exposure within your broader portfolio. So this provides a more complete solution from our perspective than just investing in pure style boxes.
That's very helpful. It is very important for investors to keep their risk tolerance and investing time horizon in mind. That's all we have time for today. John, thank you so much for joining us.
Thank you.
So that was John Mayer of Global X. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.